And good morning. Welcome to another Five with Fitz. I'm Keith Fitz-Gerald. Thank you, as always, for joining me. The markets are flip-flopping around faster than a bass fisherman trying to figure out where the lunkers are hiding in the lake. I say good, because that means there's still a lot of opportunity if you know what to look for, and even if the big traders are itching for a fight, something I noted on TV ahead of today's opening bell here in the United States. Now, I'll have more on that in a moment. First, though, and more importantly, even if the selling starts anew, if you're not investing in the best, you will get left with the rest. So here's my playbook. Number one, can Nvidia save the day? And what else I'm watching? If this were a sports game, a baseball game in particular, it'd be the bottom of the ninth as we head into the tail end of earnings season. And the question, of course, is can Nvidia and other big names that are on deck this week save the day, or will there be more selling ahead? I mean, that's the question on most everybody's minds, really. Honestly, it's a function of leverage and psychology at this point, in very technical short-term thinking. Smart investors who recognize what's on the sale rack are likely to do just fine longer term. In fact, I think it's an amazing opportunity. Now, you can watch my take with the venerable Stuart Varney, who asked me specifically about that ahead of today's opening bell on Fox Business Network. So do watch that video elsewhere on my channel. Trade idea: low balls and calls to keep risk low ahead of earnings, particularly Nvidia. Number two today, two more of the world's best investors agree with me. I could only shake my head and smile. Well, I thought to myself. The headlines are at it again. A bubble this, Mag 7 too big that, and of course, the usual commentariat clutching at their you-know-whats over tech volatility. Predictable. I mean, we've seen this play so many times, we know the lines. Here's what actually matters. Last week, I told you about how investors Ron Barron and Mary Callahan Erdos, CEO at JP Morgan Asset and Wealth Management, see what's happening as a wonderful opportunity. And news broke over the weekend that Uncle B, as in Warren Buffett, is buying Google in a very determined reversal, which I'll address in a second. Now, this morning, two more of the sharpest investors on the planet agree with me. This time around, it's Bill Ford at General Atlantic and Philippe Lafont over at Cotu, on stage at CNBC's Delivering Alpha last week, saying that they aren't worried about an AI bubble at all because, drum roll please, A, today's tech giants are generating plenty of cash. B, they're building the infrastructure. And C, they're driving the innovation. Now, I hope that sounds familiar because we've been talking about that a lot for the past few years. This isn't a recent arrival if you've been reading the Five with Fitz for any length of time or been part of the One Bar Ahead family for any length of time whatsoever. It is nothing like the dot-com era because the companies driving this whole AI shebang thing, Amazon, Alphabet, Google, Microsoft, etc., are generating almost $1 trillion in free cash flow every year, most with almost no debt whatsoever. Now, let that sink in. There is none of the usual, we promise we'll make money someday, characterized by the dot-com era, to which so many clueless, well-meaning pundits and bench-level thinkers are comparing things these days. Back then, nearly all of the capital came from speculative IPOs and flimsy startups with little or no revenue. Today, the capital comes from disciplined incumbents with the real earnings, real boards, and real actual return on capital requirements. It is a completely different universe. But the best part, Lafont dropped a nugget that most investors are going to, of course, miss entirely. Yes, compute is getting cheaper, but the number of things we can do with it explodes as that happens. A point I have made countless times. Robotics, cars, humanoids, software, workflows, entire industries that we don't even have names for yet. When cost falls but demand goes hyperbolic, total revenue goes up, not down. Not that the doom and gloom squad is going to bother with that part, of course, because half of them probably slept through Economics 101 if they intended it in the first place. Now, Keith's investing tip in this department is very simple and very powerful. Innovation may slow now and then, but it has never in the history of humanity ever stopped. Ever. Let it sink in. And do me a favor, go to the written version of the Five with Fitz today, or check the archives on my website. But take a look at the image that accompanies this portion of the Five with Fitz today. Per capita GDP since 1 AD. If you're not tracking and wish you were, I will, of course, be here along with the entire OBA family doing what we do best, which is lining up the next big movers and capitalize on chaos that most investors fear. Speaking of which, number 3, Google. The scoreboard still doesn't lie. Berkshire Hathaway has just taken a $4.9 billion bite out of Alphabet, and predictably shares have jumped more than 5% on the news. Because, Warren. Well, Wall Street's acting like this is some grand endorsement of big tech. But I say let's pump the brakes for a second. Buffett, Combs, Weschler, take your pick, have finally bought Google after spending years of saying they screwed up by missing it. Now, my POV is better late than never, in fact, but let's not pretend this suddenly makes Alphabet the second coming of Nvidia. I mean, Google is still Me Too across the board. AI, chips, data, ads, et cetera, right? Alphabet is still valued more cheaply than other AI mega caps, trading at 25.5 times the next year's earnings, compared with Microsoft at 32, Nvidia at like 41.9, Broadcom at roughly 50, which tells me that the digital spend isn't there yet, or the PE ratio would be higher. Now, to be fair, that could be and probably is what Uncle B is buying, but we won't know that for a little while. Meanwhile, the scoreboard doesn't lie, and that's what you want to focus on. $1,000 invested in Google over the last 5 years would be roughly $3,200 today. $1,000 in Palantir, roughly $10,000 today over the same time frame, and $1,000 in Nvidia, roughly $13,900 or $14,000, just call it to be round. Anyway, key investing tip in this department. Many people think I hate Google Alphabet, but that's simply not true. Investing is a series of constant trade-offs, and for the past 5 years, there have been much bigger, more profitable choices to make, in my humble opinion. Think like a shark, not a minnow. Number 4 today, Jeep. 6 years in the ditch, and now they remember the map? I mean, really? Jeep is out this week with what it calls a comeback. Now, this one's been a long time coming, and it hasn't exactly been pretty. In fact, my bride and I were just talking about Jeep specifically on our hike yesterday when we saw a new late model pull past us while sounding like the transmission was chewing screws. I could only shake my head. After 6 straight years of sales declines and a 65% drop in share price from the 2024 peak, Jeep seems finally to have realized that you can't price a mid-grade SUV like a luxury import and expect buyers to smile politely and play along. What a concept. So Jeep has reset pricing, cleaned up quality issues, at least on paper, because it sure as heck wasn't completed when it went by us. And they're rolling out new models like they're trying to make up for lost time. If I've got my data right, 4 new models in 4 months, including an all-electric Recon, a Wrangler-inspired EV that's supposed to signal Jeep's return to form. Marketing's leading hard into a comeback storyline, folks, but that's going to be a tough road to hoe, in my humble opinion. Case in point, and for example, not to pick on Jeep, but this is ridiculous. The Grand Wagoneer is a lovely vehicle, but it's a $111,000 price tag. That to me is wishful thinking dressed up in leather and chrome. Even Jeep's CEO now admits they, quote, confuse buyers and dealers. You don't say? Really? Still, and to be fair, there are flickers of progress. Jeep has just booked its best quarterly sales gain in more than 2 years, which is great, right up until you realize the inventory is stacking up like firewood. The company has got apparently something like 146 days worth of inventory, double the industry average. Then there's the timing on the Recon, right? Launching an EV right after federal incentives evaporated is like showing up late to a party just as the lights come on or the cops show up. The company says the factory can switch to producing more hybrids and gas models if needed, which, when you think about it, tells me that management already knows how this movie is going to play out. Perhaps they ought to ask Ford, but I digress. Anyway, here's the real test, though. The new Cherokee. Jeep's absence has left a hole that rivals happily filled when it came to mid-tier SUVs. If the Cherokee lands well, then Jeep might have a shot at stabilizing the business. If not, turnarounds can work, and that's what you want to understand. But they don't work on slogans, and they don't work on fancy marketing pitches. They work on pricing discipline, product clarity, and customers feeling like you can trust them again. So if you take Apple in 1997, when Steve Jobs returned, He cut the bloated product line, and he set the company on the path to the iMac, the iPod, and eventually the iPhone. And today, you know how that story played out. Or Tesla in 2018, when they clawed their way through Model 3 production hell and proved that they could actually scale manufacturing. Well, today they're leading the pack. Jeep is trying, and I applaud that because I love the brand. I mean, I've driven my share of Jeeps over the years. I've never owned one, but I've driven them, and I love them, particularly the old ones. But I'm hard pressed to imagine how they're going to get past 6 years of sloppy, inept management, poor execution, and other nonsense. Now, many argue that Stellantis, which owns Jeep, is a strong turnaround and a great buy at the moment. But I think we're far more likely to see it at $5 a share before it breaks 15. So, lowball orders, anybody? All right. And number 5 today, in case you missed it. Now, I had the distinct pleasure and honor of sitting down this past weekend for an extended discussion with the fabulous, super savvy Susie Orman to talk about why all the selling lately has been so brutal and what you need to know, and of course, a few ways to move forward with your investing anyway. I hope you are. No, scratch that. We hope you are. Remember, the markets are the only store on earth where people fear a sale. All right, you can watch that video elsewhere on my channel. Do so. I hope you do so quickly, efficiently, and with an open mind, because what you learn might make the difference. Anyway, today's bottom line, be in to win or you won't win. As always, let's make it a great day and start the week strong. You got this, I promise, and I will see you again tomorrow. Thanks for watching. Cheers.